Thank you, Ed. And I'm sure that all of you are happy that Ed is not as pessimistic as the Los Angeles Times article said he would be, starting with the funeral dirge. But we're turning to California, so before you all go out and slit your wrists, you need to hear what's happening in California. What I want to do is I want to talk about California in the context of our theme here about housing and what's happening in the housing market, how strong is it? And the question that I'm posing is, where have all the construction workers gone? May seem like a strange question, but it's going to give us some insight as to the forecasts and what's happening in housing, and some insight into something that I've been talking about since 2006, which is the bifurcated California economy. We have an inland economy that was really hit very, very hard in the Great Recession, and a coastal economy that took a much milder hit and came out of it quite well relative to the rest of the U.S. So the way in which I want to do this is first talk about what's been happening over the last year. That's going to set the stage. And then look at housing, recovery, do we have a bubble going on, and this question about the construction workers, and that'll lead us to the forecast. So let's start out with payroll jobs. You can see here, hopefully, that in the recession we lost 1.3 million jobs in California. These are payroll jobs. And we have now recovered about 736,000. There is data that suggests very strongly that when we get our benchmark revision to these numbers, and they're revised once a year every March, it's about 100,000 higher. So by this measure of employment, we are about 65% of the way back to the jobs we lost in the recession. In terms of total employment, which includes those people who are consultants, independent contractors, the self-employed, we are 95% back here in California. We've regained almost all of the jobs that were lost in the recession. So we're making progress in terms of employment. And if you look at California, so I got a call 2 weeks ago from a reporter from Sarasota, Florida, who said, our governor is going to try and poach jobs from California because you're doing so poorly. And I said, well, the first thing you ought to do is go ask your governor, why is Florida not growing as fast as California? What you see here are growth rates of employment by state over the last 12 months. Number one is small Utah, who has a very significant booming tech sector. Number two is California. California is the second fastest growing state in the U.S. If you look at the 2011, which is the latest data we have for GDP, California is one of the small group of states that's been growing much faster than the U.S. So California, in spite of all of the rhetoric and all of the rock throwing, which seems to be a blood sport in the U.S., at California is actually doing quite well relative to the U.S. We're growing much faster. And you can't see this, so I'm going to describe it to you. This is by sector. The growth is widespread. The first and sort of the fastest growing sector of the last 12 months is leisure and hospitality. But that's not just substituting restaurant jobs for factory jobs. Rather, that is a recovery of the jobs that were lost in the recession. So we're about 2% higher than in 2007 in leisure and hospitality. And it's because people are eating out more now and because tourism is up. The dollar is down and international tourism is up. Next is professional, technical, and scientific services. And then we have something that might be a surprise to you. Number three is construction. We're hiring again in the construction trades. And then we have administrative services, which is where the temps, but also the consultants hang out, healthcare. So kind of all across the board. The only place we're losing jobs in California is government, state, local, and federal, and in manufacturing. But the rate at which we're losing jobs in those sectors, those kind of perennially weak sectors, that's declining to where it's not really significant anymore. So turning to housing, this is California home sales. And And this is not seasonally adjusted, so you see the seasonal pattern. The sales are very seasonal, but if you kind of draw a line through the bottom or any kind of point there, we've had a couple of years of increased sales of homes in California. So that's sort of a solid trend. It's not a sharp trend, but a solid trend. And what's really important and sort of significant this time is what's happening with distressed housing. Because you can have a lot of sales, but if they're all distressed houses, you still have a very sick housing market. And I've been talking for some time about the fact that even though foreclosures have been falling, distressed sales have not, because banks have been moving to using short sales as an alternative to going through the foreclosure process. Well, now in California, both short sales and foreclosures have dropped. Foreclosures are now about 13%. That's the latest data that we have. And short plus foreclosures is about 30%, and that's all over California. So that's the less healthy markets plus the healthier markets. And that means that in many markets in California, we're getting back to the point where we have normal kinds of housing markets. And that's led to an increase in construction. The red line on this graph is multifamily permits. The blue line is single-family permits. Multifamily turned first and is now back to about 75% of its peak. And single-family now has a fairly solid trend. So we're starting to build again here in California and get more housing units. So this market seems to have turned around in many places, not everywhere, but in many, many parts of California, enough kind of to make a real difference in the aggregate. Every time you see a story on the news about the change in the housing market, the turnaround in the housing market in the U.S., they send a reporter to California, and that reporter will find someone who's been looking for a house, and they've made 20 offers on 20 houses, and they've lost every time because the market's so hot, and they're now bid out of the market, and so on. And what that's suggestive of is that we have a housing bubble here. So that's the question, how sustainable is this turn in the market, or is speculation again run rampant? The answer to the question, I think, can be seen, first of all, in this. This is California. The blue line is the FHFA Home Price Index for California. And you can see the bubble and the crash. So the red line is the average real appreciation from 1976 to 2002. Now, of course, homes are assets. They have to earn a rate of return for people to buy them. This is the average rate of return they've been earning. And if you can see, we're well below that now. So we're just kind of recovering over there on the right. And even if you say, well, we've rebased, so you've got to move that red line down, it still doesn't show anything like a bubble. There's no kind of excessive price appreciation. It's only really a kind of correction to overshooting that happened when the markets were in such bad shape. Now, you might say in this, well, this is California as a whole, so you're sort of averaging, those inland markets and the coast may still be overheating. But if you look at what we have, the best data we have for the coast is the Case-Shiller Home Price Index. And this is San Francisco, Los Angeles, and San Diego. And I don't need to draw the red line for you to see that, again, this is more of a return to a normal market. There's nothing here that really looks like a speculative bubble. So this notion that there's a bubble just doesn't seem to be brought out by the data here in California. And this brings us to sort of the central question here. This is a refrain that we keep hearing. This was reported on ABC News from the National Association of Home Builders. And what they said is that contractors in markets like California are complaining of they can't find skilled plumbers and framers and the skilled labor that they need. And what they're having to do is to hire people and train them because those construction workers aren't there, the ones that they sort of expected to hire. And that seems a little strange when you look at construction employment in California. At the peak, over 900,000. We lost 350,000 jobs. We've only gained some back. I mean, it's a nice trend. And remember, that's number 3 in job creation in California in the last 12 months. But there should be a lot of construction workers out there ready to take those jobs. So it's kind of hard to get a handle on, well, where are those construction workers? one theory is, well, maybe they just live in the wrong place, but all the anecdotal evidence suggests that's not true, that they are moving to where the jobs are, at least those who are there. Another is that, well, this is the skilled workers, and we've had a recovery or the beginnings of a recovery in non-residential construction. Maybe that's soaking up those skilled workers. But this is non-residential construction employment. You don't see it there. So kind of where are these construction workers? They ought to be just chomping at the bit for these jobs as they open up. And to answer that question, what I want to do is show you some things that are just suggestive, but I think they're strongly suggestive. And it's some research that was done in the 1990s on structural change and some later research. And we'll start with this graph. So all of these dots on this graph represent an incidence of structural change. So what do I mean by that? Well, in Youngstown, Ohio, when the steel industry disappeared, you had a big drop in employment. A significant contributor to the local employment picture went away. And that drop in employment created a structural change, something that was not just part of the business cycle. And on the horizontal axis here, what we have is a percentage of the total employment in that region that dropped. So each one of these dots represents one of those structural changes. So it might be copper mining in the Upper Peninsula of Michigan. It might be the closure of Fort Ord in Monterey, or the downturn in shipbuilding in Pascagoula. So real significant changes in employment. And the reason why we're looking at that is that residential construction in the inland parts of California, where most of those 350,000 workers who lost their jobs lived and worked, was a very significant part of the employment picture. It was, in some cases, 8% of total employment. And that industry shrunk, and it has stayed at very subdued levels because you don't have the in-migration that you used to have to inland California. So it's kind of like one of these. And what you notice here, so on the vertical axis is the number of years until you get to a recovery, and a recovery here is defined as getting back to where you started from in terms of employment. And what this says is pretty much no matter what you do, if you're in a structural change that's significant enough to make this chart, you're in for 5 to 7 years. So think about that 5 to 7 years. Those construction workers ought to be there, right? At least enough of them that we shouldn't be having these shortages. But research that was done on structural change, a lot of this was on the change in the economies in Eastern Europe in the 90s and other structural change in the U.S. And I've got a citation here from the Journal of Industrial and Labor Relations, which kind of summarizes that. There's another interesting study that you might want to look at. It was done by RAND, the RAND Corporation, on what happened to the aerospace workers with the 1990 downturn here in California. And all of them find that within about 4 years, all of the people who are directly affected, whether it's steel workers or aerospace workers, they've gone elsewhere. They got retrained, they retired, they moved away, but they're not around. And the reason why you get that 5 to 7 year period is that they have that secondary effect. So as they move away, or as they start running out of resources, or they retire, changing their consumption patterns, it has a secondary effect, which lasts another couple of years. So all the statistical evidence suggests that, and suggests that that what's happening is that the construction workers who are laid off, they're in the oil fields of North Dakota or Texas. They're building houses in Louisiana or New Jersey, or they're in the healthcare industry or in retail. They've gone on to other things. And there's a lot of anecdotal evidence that that's indeed happened, of skilled construction workers who say, I can't go through these swings anymore, and now I've got a steady job in finance, and I'm staying with that. And they're not coming back. So what this means is we've got now a demand-driven market in housing in California. Home prices are increasing, which is good. That's going to keep the market going, but it's not an asset bubble. And there are new opportunities for new entrants to the labor market in the construction trades, something we haven't seen for a long time. Contractors are having to train their workers, but it's an opportunity for people to move into this sector. It also means that the geography of this structural adjustment, this bifurcation between the inland and coast, is coming to an end. We're sort of in the end game here where the construction workers have now moved on, and now we've just kind of got the cleanup. So that's certainly good news as we go forward. And that leads us to our forecast for employment growth in California, 2% for this year, 2% for next, and 2.2. Those numbers are higher than the U.S. We think that California is going to continue to outperform the U.S., driving down that unemployment rate, and at the end of our forecast horizon, below 7%. And kind of one comment on this, Ed showed you that the unemployment rate in the U.S. was going down, but also labor force participation, and you could really explain virtually all of it just through labor force participation, is not going down in California. The labor force participation rate is holding steady. It means two things. One is California is really a different kind of animal here, a different economy. The second is if California, the largest state in the U.S., and a couple of others like Texas don't have the labor force participation rate falling, what's happening in the rest of the U.S.? And that's sort of a real cautionary note, and I think strengthens the view that Ed gave you of the forecast that we have some real labor market issues throughout the U.S. And finally, on the bottom, you see building permits, sort of pretty steady rise, kind of going step by step with the U.S. So that concludes the California section, and now I'm going to turn it over to William, who is going to speak about home price appreciation. Thank you.